Good afternoon, everybody, and welcome back to Markets for Millennials for the weekly market wrap from May 2nd through May 6th. And we're coming at you here just a few hours after the close of the New York trading session on Friday. And obviously, the big story this week, we've had a bunch of different significant news events, but the biggest one was the FOMC meeting on Wednesday, and what looked like a nice big bullish bounce, but then got faded and sold off heavily on Thursday. We actually, if you look at the daily chart, you can actually see we completely took out all the gains, almost all the gains from the whole week here on Thursday, and then today sold down below that. So all the gains on the week were gone. We actually ended the week down. And so we're going to really focus on what this was and kind of unpack the FOMC meeting for just a few minutes here to start out with. This is a different view of those main four indices. In white, you see the S&P, the NASDAQ in orange, the Dow in blue, the Russell in yellow. And you just see that bounce in all four of the equity indices, and you saw that bounce generally across all risk assets. And so the question is, what happened here? So I just want to kind of take a step back and show you here. On April 28th, I had this thread, and I'll start here with the where I talked about how I believe that I just don't know how every rally doesn't get sold until at least the FOMC, because the market tends to trend into what it is expecting. So the market's always pricing in new information. It's forward-looking, it's not backward-looking, and so at every moment, the market has to digest and take in and price in whatever it's expecting. And I think the issue was there was, I don't remember, I think it was 2 weeks ago, maybe it was last week, early in the week. One of the members of the Federal Reserve floated the idea that 75 basis points might be on the table or could potentially be on the table. And the reason why that was a big deal is because all in this area on the chart, like right before we had this drop off. So I actually think that a lot of the, like in this area, the market was getting ready to, and I should actually put the 50-day moving average here, because I remember thinking off this bounce that the market was wondering right here if it was going to find legs to continue to the upside. And what happened is, the market ended up reacting to very hawkish discussion by central bankers around the world, including Powell. And that followed up immediately with the idea that a 75 basis point hike might need to be on the table. So I was talking about how the markets, we definitely know that 50 basis points was coming. I could have even also added that we know QT was coming, and it was just a matter of how much QT was going to be done and when they were going to start it, whether it was going to be immediately or at a later time. It obviously ended up, it's going to be on June 1st or starting June 1st. So it priced in 50 basis points, but it was trying to consider the possibility of 75 basis points. And so a lot of this price action for the last couple of days, with the down and then the up and then the down and then, like kind of this holding pattern here, was because I think the market was trying to digest the possibility that the Fed was going to announce 75 basis points, and it didn't seem likely. And I think that's why you can actually see here this wick right here. I think that's why that wicked like that and ended up green on the day, because I think the market started to think, 75 basis points might not actually happen. And so I think because of that, we got a couple of extra small green candles in preparation for the likelihood that 75 basis points wasn't going to happen in this meeting. But then at the same time, could 75 basis points happen in the future? So that's what I was talking about. And then I said, okay, so if the Fed doesn't hike by 75 basis points, I'm going to consider that a surprise. and I think we get a rally, right? And I talk about that that a little bit further here. So what happens? So the Fed raises interest rates by 0.5%. And the other thing that was getting interesting, and I'm trying to see if it's in this article, I'm not really certain. So they talked about starting June 1st, they were going to start the roll-off in their purchases off their balance sheet. And I don't see the other part of the story that I was considering or thinking through. But point being that one of the things that happened during the meeting is Powell took 75 basis points off the table. So what I'm doing here is I'm going to go back to May the 4th on a 1-minute chart because I want you to see how this transpired. Because you can kind of see beforehand, you had the market come down a bit, but then come back up. And then we were just generally kind of trending sideways going into the FOMC announcement. So the press release was right here. If you see where my mouse is, right here on this candle. And then you can see these 1-minute candles start getting a lot bigger as the market is digesting that news for the first 30 minutes. But obviously the real show is the press conference. And so 11:30 on this red candle is where the press conference starts. And then what you actually see is he gives his initial statement about 50 basis points and the the balance sheet roll off. And then he gets into his press conference. And at one point in his press conference, he got asked about why not 75 basis points. And he essentially responded with 75 basis points is off the table. We believe, and he basically said, we believe that it's going to be 50 basis points, going forward as well. So according to Powell, there's no discussion about having any point of time this year where we do 75 basis points. And that's where the market really rocketed off. And so you actually get the rocket up, and we ended up being up over 100 S&P. I think it was about 130-ish S&P points. And then on the E-mini futures, you actually see price go sideways after that. You see the volatility in comparison muted after that. Right, so then we go through into the May the 5th, and then suddenly something changes on May the 5th, and the market realizes something is not right, and so essentially right at market open, so we kind of trended down a little bit from our close from the previous day, but then here we are at 9:30 Eastern time, approximately right here. As soon as that happens, the market just sold off and just continued to sell. All throughout the trading day. You only got a tiny little bounce, I guess it's a pretty considerable bounce, but you only got a bounce right at the end, and then, but this is like just pronounced selling the whole time, and so a lot of people were really confused by that. Let me go back to my daily chart, and a lot of people were really confused because they were thinking, well, wasn't this dovish? And the answer is yes, kind of. Because ultimately 50 basis points it means, and taking 75 basis points off the table is obviously like more dovish than the potential possibilities. However, wrong chart. However, what the markets, I think what people didn't realize at first is that another thing Powell said was that they were willing to go above neutral, or beyond neutral, I guess is the right way to say that, in interest rates. And so, I think that that's something like it's alarm bells for that, because what that ultimately means is that the Federal Reserve is very comfortable because of the inflation mandate. And this is something I've talked about in these videos, my weekly updates, and in my newsletter, that the Federal Reserve is committed above all right now to inflation. They're not committed to propping the markets up. So that means that if they are prepared to go beyond neutral, then what this ultimately means is that they're willing to see to have things be such that price in the risk asset markets they're potentially going to sell off considerably more. That it means that that their policy is essentially, inevitably, it looks like, going to lead to recession, because again, their main priority is inflation above all. And I think the markets realize that today. I've heard some other people talk a little bit about that also, but that's why the markets are coming down today, or have come down these last 2 days. Now the question is, will this continue? Will the selling continue? And I think that what was really interesting is, depending on what you're looking at, we're at some pretty critical levels that we need to hold. Otherwise, we could totally see a waterfall down. So one of the first things I'd like to take a look at before we go into the equity indices, let's take a look at rates first. So a lot of us have been watching. Let me zoom in a little here. A lot of us have been watching a trend line that was essentially like this. Let me extend that line so it looks a little bit better for you. Basically watching something like this. It broke down. A lot of people were looking for a bounce, myself included. And then we broke down, but then price ended up making a higher high. And now here we are back at, look, we closed, yields today closed at 3.136%. So just again, continuing this incredible run in yields. And I put this yellow line here because I was looking to see if, and again, back when I had the line here, I was looking to see, one, if we were going to either make a higher high or if we were going to make a lower low. So this is my lower low, and I thought that if we made a lower low, then we had a couple of different lines that we could bounce on. Maybe you can see those faint dotted lines behind. But obviously we've made a new higher high and have just rocketed up. So another way that we can look at that is by looking at, actually let's look at the TIP ETF. So if we just pull this back, and maybe we'll do this so it looks a little bit nicer on the screen. You can actually see that the treasury bonds have been selling off like crazy. We're below our pre-COVID levels. The prices right now are at the level that they got to, let's see, the last time. So prices were rising of bonds, and the last time we were up at this level was in 2019, right before, interestingly enough, right before the repo market busted, which obviously was the last time also that we got a yield curve inversion. So that's definitely something to note. And then looking at junk bonds, which is a much better indicator of risk. You can see here, I talked about this I believe in my newsletter, but we never made it back to our pre-COVID high. And we've just kind of been rolling over, interestingly enough, since September of 2021. That's the last time we made, that was our most recent high. And so we've been selling down ever since. That's kind of a big deal, I think. And so that was one thing I wanted to look at. Another thing is the continued appreciation of the DXY. And I have another tweet about this. And, I've been talking about the rise in the US dollar, and I've been on Twitter talking about how people are keep calling dollar tops, and I don't know why they're doing that. And I wrote this on May 2nd, so on Monday this week, and I said I'm watching for a possible consolidation in this range on the DXY. And this was at like 8:30 in the morning, so we were not yet at the FOMC meeting. But the reason why, and I think I put this here. And the reason why I believed it was going to consolidate there is because if you pull up a 3-day chart, we're at about the range that we got to on the spike high in March of 2020 during the dollar milkshake, the liquidity crisis when everybody rushed to dollars. And so we just broke above that spot. And so I was looking for a consolidation right around there. And so look at where price is. Let me actually go to a 3-day chart so you can see what that looks like. So that was kind of right around here. And it looks to me, I could be wrong, but it looks to me, I often watch on the 8-hour chart throughout the week, but you actually kind of see here what I was doing. I had an initial kind of flag pattern, and then I adjusted it, flattened it a little bit, but then I added this yellow dotted line too. And basically what I was looking at is different potential patterns, because I wondered if what we were actually about to see was something like this. And if we actually were consolidating up that way, then I was actually going to say that probably what we would see is the dollar top out around 104 or 105 and then roll over. But now that didn't happen, so we have, obviously we touched the bottom of this flag, and we bounced, and it actually looks like we're out of that now. So I'm actually, well, I don't know. Like, as I look at it now, you tell me. It looks like this is almost like a fake breakdown. So now we're actually still closing. We're still above this this line. So depending on how you look at it, either this was a flag pattern like this, and we finally broke up, and we're about to resume up going into next week, or it was a pattern like this, and this is a fake breakdown, and we're gonna kind of consolidate maybe in an upper, or we're gonna move slowly in an ascending channel, or possibly an ascending wedge. So that's definitely something I'm gonna be watching for going into next week. So for now, I'll leave those lines there. It looks a lot cleaner on the daily chart, but you can kind of see that. But we are closing at the highest level, around the highest level that we've been at for some time. So our close today is 103.658. Our close from April 28th last week was 103.928. And so, wait, hold on, sorry, that's wrong. 103.668. So we're not that much lower than our close from last week, and I just expect that this is going to continue up. Look, I keep saying it on Twitter, but the trend is your friend, and the trend is up. And there's no reason, given the macro backdrop, there's no reason to think that the dollar is going to come down anytime soon. And I made a thread about this, that people keep trying to say, okay, RSI, okay, MACD, there's all these indicators that are indicating overbought, but the DXY is not a normal instrument to look at. It's not a stock, it's not a commodity, it's a basket of currencies. And so the DXY can go up as long as it wants, as long as the currencies in the basket keep getting destroyed. Let's see, I think it was USD, GBP. I believe it was the British pound got destroyed yesterday. And so that was part of the reason why we got a huge up day on the dollar. And then if you have the Euro US dollar, if we take a look at that, that continues to get sold, although not quite as much as the British pound did, but that was still a big deal. And then you have also the US dollar, Japanese yen, which continues to just grind up to new highs. And so the DXY, like those are the bigger, the three bigger ones. Obviously the euro's a little over 50%, the yen is close to 20%. But point being that the DXY can go up as long as those other fiat currencies continue to be devalued versus the US dollar. Right now, there's demand for US dollars. And so as long as that keeps being the case, given everything that's going on in the world, the dollar is going to continue to grind higher. And it doesn't matter what your lagging indicators say. You just got to continue to follow price. And you can't let your bias or what you desire to happen prevent you from seeing what price is showing you. And that's that. Going back to the equity indices, something I wanted to talk about here was how we're bouncing at pretty significant levels. Actually, let's go to the Nasdaq first, because what I want to show you here, you can actually see, you might have seen it earlier, this solid green bar right here. What I noticed, what was interesting was, because after the COVID crisis, we the NASDAQ is the one that kind of led the way for quite a bit of that initial recovery. And it was just incredible, the increase that was had. So I was watching the NASDAQ and I realized the level that we're coming to was a really important level. We got two 10% drawdowns on the NASDAQ, two 10% corrections in 2020, one in September to the end of September, and then one from mid-October to the beginning of November. And those obviously were from the wick lows. It was an 85% gain. So just a ton of upside price action. So what you're going to see here on the NASDAQ is a lot different than what you'll see on the S&P and on the Dow and even on the Russell. But what I did was I came back and I basically touched, I basically made this box, which is touching the top from September 2020 and the top from October 2020 before the 10% pullbacks. And I took that range and then I expanded the box to the right. And what I noticed is that very soon we are going to get to the point where we're in that zone, which had previously been resistance. And you can actually see in December 2020 and in March of 2021, it was support. And even if I wanted to expand this up a little bit to this zone, this is a really big supply zone. It's got to hold as support, because if it doesn't, then I think that the NASDAQ is going to go down below 11,000, which is pretty incredible to say. But I can't see it I can't see any other way. Which if that's what happened, and again, like, I mean, anything can happen. But if that were to take place, if we were to come down to below 11,000, then I mean, what we're looking, that's over a 30%. That's 34% down, which would be quite remarkable. But again, that's something I think is going to be a really important level. If you are the buying type, if you're the type that wants to find good places to buy on dips with good risk to reward, in terms of price action, I'm not talking about fundamentals right now because obviously so much of the NASDAQ is overvalued in terms of earnings and things like that, trading at very, very, very high multiples. So, but on a technical standpoint, this is a great spot to be a buy on dip or a buyer on dip. The problem is, will it hold? And so I'm going to be watching that for sure. But then when you look at the S&P on the E-mini futures, that level is way lower. So what I did was I went to all of the equity indices and I went and found those same levels. And the S&P was very similar to the NASDAQ, where the first bounce was the higher one and the second bounce was the lower one, with 10% drawdowns. But even to get to that level on the S&P, you're looking at it being, I don't know why it keeps doing that. Sorry, hold on a second. Let's see if I can, I don't know where. Let's see, here we go, center. That would be a 25% drawdown, which seems pretty crazy considering that the S&P has only, like, we closed today 14% down. So the S&P has a lot more to fall. But obviously that would be 25%, while the NASDAQ would have fallen 35% if we fall to those levels. And then the same thing on the Dow. So the Dow, actually, here we go. The Dow had, the first peak was also a little bit higher. A drawdown from there would be a little over 20%, so that would be full bear market even on the Dow. And what I think is interesting to note is if you do it on the Dow, that would actually put us below our pre-COVID level on the Dow. We would have given up everything that was gained after retaking the highs post 2020 election, actually, which is pretty interesting. Actually, let me double check the S&P really quick. I can't remember if that's the case. Nope, would not be the case on the S&P. And then the Russell, if we went to that same levels, the Russell actually had a higher second peak than what happened in September. And this is actually a little bit off. Got to put that right there. So if this happened on the Russell, then this would be, whoops, that's really bad. That would be a little over 30% of a drawdown. Obviously that wasn't exact, but you can see what's going on there. If we go back through all the indices really quick with all of the major moving averages on, I talked about the crosses on the 100-day below the 200-day. Moving averages are all curling down in all of the indices, or have already curled, I should say. Things do not look very good. We've made lower lows. Ultimately, like, it's really hard because everybody is so bearish out there, that and I think the market is coming more and more to grips with the fact that the Fed is committed to stopping inflation at all costs, even if it means crashing the markets. So the markets could have a lot lower to go before we hit bottom. However, it's one of those things where as soon as the market participants all become bearish, that's when things turn typically. And so that's something I want to watch out for. Ultimately, you can see on all three indices, I'm watching a specific line of repair. It's going to be the most important lines of repair. You can see that clearly in these charts, that solid line right here. But obviously this can change as we trend lower, if we do trend lower. I think obviously this is something that we have to be very cautious about. Be very cautious about shorting the market here, because obviously, if you took a short position down here, then it's possible you got destroyed to the upside. Because in bear markets, the rallies in bear markets are very massive usually. Just like in bull markets, the corrections are often very brutal. So definitely something to be watching out for and to be on your guard about. Gold has had a pretty depressing week, to be honest with you. Sold down almost 2% on Monday, gained almost all of it back, wicked up above our open from the week, but have since closed down. So on the week, it could have been worse, but we're down a little under 1% on the week. So gold just continuing to be a disappointment, and not doing what a lot of people I think have expected. Silver also a very disappointing trade, trending to the lower part of its consolidation range from 2020, or which started in 2020. On oil, this is actually happening faster than I thought it would happen, but I've talked about this a lot in my newsletter. I've been tweeting about it, that I had suspected, going back here, I suspected that we were going to be resting in this area for some time, between the 93 level and the 113 level, approximately so. And it looks actually like oil wants to go higher, and we made a higher high here, but we're stuck still under the 0.5 level on these Fibonacci zones. So what I'm wondering is, are we in for another potential sell down before bouncing back up, or is all of this happening faster than I thought and we're about to just take off and make new all-time, or new highs, I guess, not all-time highs, but new highs. And I'm not really sure. Definitely something that we need to be watching for. A lot of people have been talking about how oil was going to, people were talking about, oil's going to go back down to the low 90s, it's going to go into the 80s, and maybe even into the 70s. And those people are just not paying attention. And I think what's really interesting too is to see oil moving such while the dollar is moving as high as it is. Because obviously when the dollar is strong, then assets that are priced in dollars actually tend to move down. There tends to be a correlation there. It doesn't have to, but it tends to, because obviously when things are priced in dollars and the dollar becomes more expensive, or the dollar grows in its value, it typically means it's able to buy more of things, and so or it takes fewer dollars to buy more things. So it's interesting again to see that oil is really coming up as the dollar is coming up too. It's just kind of a thought. And then finally, Bitcoin. I've been recording about 30 minutes now, so I apologize, it's been going long. But Bitcoin, we're in a really precarious situation. We broke below what a lot of people were calling a bear flag. And it looked like also, again, on the FOMC release and on the press conference, we sold up. It looked like it looked like this was going to be the new leg of a rise that was going to take us back to the top of this channel that we've been in for a couple of years. But now it's actually looking like we're going to come down and test the bottom. We got really close to testing the bottom here of this channel. Channel's coming in at, let's see, channel today is coming in at about 35,000, almost exactly. And obviously Bitcoin and crypto trades 24/7. And so this is going to be something that a lot of us are going to be watching this weekend. One little note about Bitcoin. I saw this and I wanted to do some research on it. A lot of people have been talking about how on the weekly chart, the 100-week moving average, we're actually, the weekly chart is still not closed yet. But something that is very interesting is when you go back to previous bull runs, and I'll put on the log chart so it's a little bit easier to see price action. But on the weekly chart, anytime we've closed after a bull run, so my criteria is post-halving. Once you pass the halving and you have a bull run, then once the weekly chart closes below its 100-week moving average, that's where the capitulation happens. So that happened right here, and I'm gonna just kind of mark that spot. So the capitulation low was approximately 44 to 45% below where the 100-day or the 100-week moving average was. Okay, and then when you come back again using the same rules, so post-halving, the 2012 halving was in November. So post-halving, after the bull run, as soon as price has a close, so this one was interesting because we bounced around it a little bit, but as soon as price had a close below, if we just mark it from that spot, a close below the 100-week moving average, then from that moving average to the low, from here is about 36%, but from where the breakdown never went back above the 100-week moving average, it was 42-ish%, and that's not including these wicks. If it goes down to the wick, it's even more from both. And so what I would say is between 35 to 55% if you're using price history as the indicator for that. So there's definitely a reason to be concerned about that because from where price is currently at, a 35% drop puts us down at about 23,600, and a 55% drop puts us down around 16,000, and then 45% puts us right at the previous all-time high. So time will tell what happens, but it's definitely something to watch out for. Trade safely, trade carefully. I hope you guys have an excellent weekend, and I'll see you guys next week.